Welcome back, everyone. I am absolutely pumped to dive into today's explainer. Think of this as your ultimate step-by-step exam review and masterclass for actually executing chart pattern trades. We're going to take all that raw theory you probably already know and, well, translate it into real-world execution. Because let's face it, if you've ever stared at a chart, spotted a pattern, but then just kind of froze, not knowing exactly when to enter, where to put your stop loss, or when to take profit, you are in exactly the right place.
But hey, before we get into the heavy lifting, I want you to really think about something for a second. If the market breaks resistance, where do the amateurs put their stop loss? Just let that simmer. It's a massive question, right? Because understanding where the herd is frantically placing their orders is absolutely crucial. It's the key to understanding market liquidity, and more importantly, it keeps you from becoming someone else's exit liquidity. Real-world execution literally starts with knowing exactly what the crowd is getting wrong.
And honestly, that leads us right into what I call the novice trap. Picture this. You've got an eager new trader. They spot a textbook double top. Oh, it's beautiful. They draw their neckline perfectly, the price breaks below that line, and bam! In all their excitement, they immediately smash the sell button, shorting the breakdown. But what happens next? The market dips for a split second and then violently rips back up, closing right above the neckline. Our poor novice, completely trapped in a false breakout. Their stop gets triggered and they're just left scratching their head. They traded the textbook perfectly, but they got absolutely crushed by reality.
So, to make sure that never ever happens to you, here's our game plan for today. We're covering 1. Chart pattern psychology. 2. Reversals versus continuations. 3. Double tops and bottoms. 4. Step-by-step execution logic. 5. Calculating classical price projections. And finally, 6. Trader discipline and mindset.
Okay, let's jump right into Section 1, Chart Pattern Psychology. Because to master execution, you really have to master the mindset that's actually driving those candlesticks.
When you're looking at a valid chart pattern, you've got to remember you aren't just looking at geometric shapes, right? You are looking at raw human behavior. So one of the absolute strongest indicators of a true valid breakout, instead of one of those deceptive false moves we just talked about, is a volatility contraction. It usually looks like this tight little consolidation, a buildup, right at a key level of resistance. Think of it exactly like a tightly coiled spring, just storing up all this potential energy. If you start seeing higher lows repeatedly pushing into that resistance, it's a huge signal. It means buyers are stepping up, willing to pay higher and higher prices, while the short sellers are just slowly, painfully getting trapped. It's that exact buildup of energy that eventually triggers your explosive, tradable breakout.
Moving right along to Section 2, reversals versus continuations.
Basically, there are two main cams of chart patterns you're going to encounter on your exam. Think of this as your visual cheat sheet. On the reversal pattern side, we've got stuff like head and shoulders or your double and triple tops and bottoms. These are massive red flashing lights signaling that an existing trend is exhausted and about to violently change direction. Then, over on the continuation pattern side, we've got things like the cup and handle, ascending triangles, bull and bear flags. These basically tell us the market is just taking a quick breather, consolidating that potential energy before it continues marching in the direction of the underlying trend. Honestly, memorizing these two categories is just fundamental. You have to know which way to bias your trades.
All right, Section 3, double tops and bottoms.
Let's zoom in on these two, because they are essentially perfect mirror images of each other. A double top, that's a bearish reversal. It literally looks like a giant M forming right at the peak of an uptrend. The market tests the high twice, totally fails to break through, and the reversal is officially confirmed the second it breaks down below that support neckline. On the flip side, the double bottom is your bullish reversal. It forms a nice W shape right in the middle of a downtrend. The market tests the floor twice, absolutely refuses to go any lower, and boom, confirmation hits when the price rips right above the resistance neckline.
Now for the really fun stuff. Section 4, step-by-step execution logic.
As we saw earlier with that whole novice strat scenario, just knowing the shape of a pattern isn't enough to save you. It is time for the hard math. Let's walk through the exact mathematical procedure for placing a truly objective stop loss. Let's say you want to enter a false break trade. Maybe you spot a bearish shooting star candlestick, blatantly rejecting resistance during a double top formation. You know you want to short, but where exactly does that stop loss go? Listen, you do not just guess. Step 1. Identify the exact high price of your entry candle. Step 2. Pull up a 20-period average true range, or ATR, indicator to measure the market's current volatility. And Step 3. Simply add that ATR value directly to the high of your candle. This is brilliant because it ensures your stop loss is based on real, objective market volatility. It gives the trade just enough room to breathe without getting prematurely stopped out by random, meaningless market noise.
And the whole reason we use the ATR from our entry candle or wait for specific structural moments boils down to one thing: your risk-to-reward ratio. If you use a massive, wide stop loss, placing it way up above an extreme swing high on a giant pattern, well, you are taking on tremendous risk for a relatively tiny reward. The absolute paradigm shift for professional execution is waiting for a tight consolidation buildup, or what we like to call the first pullback after a breakout. By entering there, you can tuck a tight stop loss just above that minor pullback structure. Tighter stops drastically shrink your risk, which, mathematically speaking, just explodes your potential risk-to-reward ratio. It's a total game changer.
Which brings us to Section 5, calculating classical price projections.
Okay, so once we've safely entered the trade and secured that stop loss, we kind of need to know where we're going, right? Let's anchor our math on a really simple number for a second: $50. In classical technical analysis, we aren't throwing darts at a board to guess where the market will go. We actually use the geometry of the pattern itself. So let's say you're looking at an inverse head and shoulders pattern, and the absolute lowest point of the head is sitting right at $50.
Now, if the neckline of that exact same pattern sits at $100, the distance from the head to the neckline is exactly $50, right? Simple math. To find your ultimate target, you just follow this classical price projection method. Step 1, measure that head to neckline distance, in our case, our $50. Step 2, copy that exact distance. And step 3, project it straight upward from the exact point where the market breaks out of the neckline. So if we break out at $100, we just add our $50 projection. That gives us a highly logical, mathematically sound profit target of exactly $150.
Finally, we arrive at Section 6, trader discipline and mindset. Look, we've covered the patterns, we've crunched the math, and we've set the targets. But I promise you, all of that is completely useless without the right psychological component. I really want this quote etched into your brain. We are dealing with probabilities, never certainty. Seriously, you can have a perfect build-up, a textbook higher-low ascending triangle, a mathematically flawless ATR stop loss, and the market can still just turn right around and stop you out. Maintaining this exact mindset is absolutely required if you want to avoid impulsive, emotional revenge trading when your perfect patterns inevitably fail. And they will fail sometimes.
And here is a brutal reality check straight from the source material to prove it. They break down this chart for Brent crude oil. It was a flawless setup. Price pushed into key higher time frame resistance. It formed a textbook false break, rejecting the highs. The entry trigger was crystal clear. The ATR stop loss, perfect. And what happened? The market triggered the entry, immediately whipped around, and blasted right through the stop loss. It was a loser. Yep. Even when you do literally everything right, the market can still prove you wrong. So, how do the pros actually survive this reality? Well, they follow incredibly strict rules. When a trade works, they don't just blindly guess when to exit, they trail their open profits with a 50-period moving average. This locks in gains dynamically while letting the trend run its course. They also completely avoid impulsivity, literally just sitting on their hands during messy, choppy consolidation phases. They fully accept that the word confirmed, when we're talking about breakouts, really just means higher probability, absolutely never a guarantee. And most importantly, the ultimate ironclad rule of the pros: they never, ever risk more than 1% of their total account capital on any single trade.
So I'm going to leave you with this final provocative thought today to really challenge your own habits. Are you currently risking more than 1% just to find out if your so-called confirmed pattern is actually going to work? Because let me tell you, if you are, you aren't trading probabilities anymore. You're just gambling. Take the step-by-step logic we outlined today, tighten up that execution, respect your risk, and let the math do the heavy lifting for you. Thank you so much for joining me on this explainer, and I really hope this completely transforms the way you look at your next chart setup. Catch you next time.